talking about MACD, moving average convergence and divergence. Now, in tonight's class, I'm going to share with you a little pre-prepared presentation on trading with MACD. And if you wish to see this again, it doesn't re-record these presentations within the webinar because they don't want to have copyright infringements. So if you'd like to see this presentation, you can go to our YouTube station at Forex and CFD Education. That's the name of the channel at YouTube. And then look under the playlist for MACD, and you'll find these short little presentations already for you. Also, if you look on your screen tonight, I have prepared 3 handouts for you. There's the Introduction to Technical Analysis from Investing.com and Technical Indicators from Investing.com and the MACD Indicator Guide. Okay, all of these have been put together just for you, and they're only available in this live class. So in the recorded version, you cannot download these. So if you wish, click on the little download buttons on your screen and download them to whatever device you're using tonight, whether it's a mobile device or a PC, and then you can move them around at your convenience. Now, in tonight's class, I'm going to mix up the term security and asset. I might say Bitcoin, I might say shares, I might say Apple, I might say the euro. In fact, I'm not talking about a specific instrument. I'm talking about all publicly traded financial instruments in which there's an open market. It just gets very, very boring saying security, security, security over and over again. Also, I mix up the terms in investing and trading. Now, typically an investor takes a long-term position while a trader takes a much shorter-term position. In either case, the basic concepts and techniques presented in the class are equally adept. But it just, again, gets very, very boring saying trading, 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 trading. Now, MACD falls in the field of technical analysis. And you know, everybody's always asking questions. Should I buy today? Should I sell today? What will the prices be an hour from hour, tomorrow, next week, next year? Wouldn't investing and trading be easy if we knew the answers to these seemingly simple questions? Well, I don't have a crystal ball, and I don't have a Ouija board, and I don't think any of you guys have ones that actually work. So if you're attending this class in the hopes that technical analysis has all of these mystical answers to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this webinar with the hopes that technical analysis, and especially MACD, will improve your investing and trading, I have good news for you. It sure will. Now, MACD is one of the most respected technical indicators in the marketplace. It falls into a group that we call bounded oscillators. And MACD has been around a very long time. And it has withstood the test of time. And it works well for Forex, for cryptocurrency. It works well for stocks. It works great for commodities. It works well for almost all marketplaces. Now, MACD stands for Moving Average Convergence and Divergence. That's a whole mouthful, isn't it? I like the way it sounds, though. So I like this indicator. But it is one of the most prevalent indicators used in the Forex market. It's used to discover new trends, to help identify the end of current trends. Now, there are various ways to gauge the signals generated by MACD, and many traders use their own unique settings and methods around this trading indicator. Now, the MACD indicator is typically placed at the bottom of the chart, underneath price action in a separate window. The moving average convergence divergence tool is a relatively easy tool. However, it's crucial to understand it fully before attempting to trade with its signals. Now, this is the one and the only time you'll have to understand and learn all of the formulas for MACD, because all the charting service will automatically drop MACD onto your charts. So you never actually have to do calculations. But in order to be able to ferret out false signals or understand what MACD is trying to tell you, because markets are always different, you have to understand what makes up each one of these lines that becomes the MACD. So the basic concept behind MACD is fairly straightforward. It calculates the difference between an instrument's 26 and 12 period EMA, exponential moving average. Of the two moving averages that make up the MACD, the 12-day or 12 period EMA is the faster one, while the 26 period is the slower. Now, for those of you who don't know much about moving averages, whenever you have multiple moving averages, the one with the shorter period is always considered faster, because if you were taking in this case, a 12 period moving average, you would be going back 12 periods. So if you're using a 1 hour chart, you'd be going back 12 1 hours, adding all the closes together and dividing it by 12. When you're using the 26 period moving average, and we're talking about a simple moving average, you'd go back 26 periods, add them together and divide by 26. So it's kind of obvious that if you have a significant price move in the last couple sessions, the 12 period is going to react a lot faster because it's adding those last few periods and only going back a little while, where the 26 period is adding those new prices that had the jump up, say, back 26 periods, so it's going to react slower. But this is simply understanding moving averages. And it happens to be what the formula I just gave you was for a simple moving average. An exponential moving average gives a little bit more weight on top of it to the most current prices. So let's go over to a chart, and I'm going to try to explain this to you step by step. It gets a little wordy, and I'm sorry for that, but there's so many lines that make up MACD, you have to understand them. And so it's important that we do. So let me pop up a chart here. Okay. So the first thing we're going to do is we have a standard, we're using my standard teaching chart. This is the Euro US dollar 30-minute chart. It's the most current chart. And we're going to drop on a chart the 12 period exponential moving average. Okay. And that is the gold line that I just dropped on your chart. Simply a moving average. We're also going to drop on our chart a 26 period moving average, which is the blue line I just put on your chart. Now these are simple, or these are non-complicated moving averages. And if we were to trade from these two moving averages, we would be trading what's called a moving average crossover strategy. It's a very basic strategy, gives us some information, gives us some really relatively simple buy and sell signals that are too simplistic. But for MACD, this is the first step. This is the first derivative of price. So this is where MACD starts. Now, what MACD does is it takes the difference between the 12 period EMA and the 26 period EMA. So in other words, it takes the gold line and subtracts the blue line from that, and the difference is plotted down below. It's plotted in this area. And this difference is referred to as the MACD line. Okay. So I just dropped that on the chart below, and all this is the difference between the two moving averages above. Now this is plotted on a chart that's centered on 0. Because when the two moving averages above cross over each other, what would the difference be? It would always be 0. So anytime that the price or the MACD line down below, the blue line, crosses the 0 line, we've had a crossover of the moving averages. When it crosses over, when it moves up above 0, that's telling us the 12-period moving average, the gold line, is larger than the 26-period moving average. When it crosses the 0 line and comes down, it's telling us that the 26-period moving average is larger than the 12-period moving average. So what it's doing, it's interpreting everything that we see on these two moving average lines that we have on the chart. So we can remove these now from our chart because we have no need for them. And now we have all the information that was obtained from those two moving averages down below in what now is this blue line that I put on the chart, which is referred to as the MACD line. Now, if we were to simply trade this line above and below 0, we would be trading those two moving averages, or again, a simple moving average crossover strategy. But because we need something a little bit more precise and a little bit better, okay, we have to go several steps farther. So what MACD does now, it takes an average of the MACD line over a 9-period moving average and drops that on the chart below. And this is called the MACD signal line or a trigger line. So that is the gold line I've just dropped below. So now we have the relationship between the blue line, which is the combination of the two moving averages above, with another line added to it that's the moving average, the 9-period moving average of the MACD line. And this line, this gold line now, is called the trigger or the signal line. When it crosses above or below the blue line, it gives us buy and sell signals, which are fairly accurate. Now, it's taken a lot of steps to get here because now we have a derivative of a derivative of a derivative of a derivative. But we're not finished yet because now we take the difference between the MACD line, the blue line, and the gold line, and we subtract those. And these are plotted on the chart by something that's called a histogram. A histogram is simply a bar chart, bar graph of the difference between these two lines above. So again, if I were just to get rid of these two lines, the MACD histogram, when it is at the 0, on the 0 line again, it tells us that the MACD and the MACD signal line have just crossed each other. If it crosses up and over, we would see that as a mountain. If it crosses under, it's as a valley. So at this point, when it crosses over the 0 line and moves upward, it's giving us a buy signal. When it crosses over and downward, it's giving us a sell signal. And if we go back to look at the crossovers and match it up to price action, we can see it's fairly accurate. Now, keep in mind that at no time did we talk about how far an asset might move, because that's one of the shortcomings of MACD. MACD will give us buy and sell signals. Hold on a second. With the crossovers, but there's nothing to tell us how far we can expect that price to go. There's also nothing that tells us where to put our stop loss either. So MACD tells us or gives us a buy or sell alert. It'll give us overbought and oversold condition. It'll give us divergence without giving us price and how far an asset will move. So it's important because MACD offers a great deal of information, but you have to have other ways to determine if you're going to make the trade, because MACD can give you not necessarily a great deal of false signals. What it'll give you is a great deal of signals that are correct, but the asset won't move enough for you to break even or make profit. So it might be a good buy, but if the euro US dollar only climbed, from the MACD signal crossover, only climbed 10 points, and you've got an 8-point spread and you couldn't get into the trade because you can't get into trade the second MACD crosses over. So by the time you got into it, it already climbed 4 points. Well, with your 8-point spread and your 4-point, lag, you need a 12-point move just to break even. But MACD didn't. The price didn't move 12 points, it moved 10 points. So you end up with a losing trade because MACD doesn't tell you how far an asset's going to move. It just tells you you have a buy or sell opportunity. Okay. Now, MACD also gives us two other stories. It will give us it will give us overbought and oversold conditions. So in other words, when the MACD line pulls far away from its signal line and climbs, it's going to tell us that an asset is overbought. When it does the opposite, it's going to tell us an asset is oversold. The easiest way to see this is in the histogram. When you see the histogram forming big mountains or big valleys, it's telling you have overbought and oversold conditions. Now, you can also have divergence. For instance, in this case, we see the histogram moving this direction while price is moving that direction. So that's simply a divergence. But there are different ways to use the MACD indicator. It's a great indicator, but you have to understand what to do with it. So let's go back to my presentation. And so now you know how to put MACD on your chart. So all of those lines I was turning off and on. When you click on the MACD indicator on your chart, it just drops it all on there. There's nothing you have to do. I was turning them off and on so you could see each line as we were talking about it. But all you have to do is click on MACD indicator. It's going to give it to you automatically in a 12, 26, and a 9, because that's the way Gerald Arpel developed it. You could decide you want to use a 12, 26, and a 16. You could use a 9 and a 22 moving average and a 6 moving average. But then it's no longer the standard MACD, and you'd have to test it and back test it to see how the results would work. So now in this little chart here, you can see that the MACD helped traders notice the trend change at a very early stage. And that's when price crossed over or under that zero line. Okay. This is a key part of the indicator, and sometimes will help delve much deeper into, or something we'll delve deeper into in a presentation I'm going to share with you. Using MACD as a trigger into trades. But before we go into that, you probably noticed that the zero line drawn on the MACD indicator is in the above chart right here. This is a key part of the indicator as it shows us when there is no difference between the EMAs. MACD will cross the zero line as the faster moving average intersects the slower moving average. So again, we get three stories from MACD. We get convergence through the crossovers, we get overbought and oversold conditions, and we get divergence. So the basic MACD trading rule is to sell when the MACD falls below a signal line. Similarly, a buy signal occurs when the moving average convergence divergence rises above a signal line. So in other words, whenever they cross over. So when they cross over and above the buy signal, you would see it cross, you'd see the histogram rise. And when it crosses below and under, you would see the peak in the valley in the histogram. And you see they are fairly accurate to tell you when trend is changing or giving you a position to enter. Now, the MACD is also useful as an overbought and oversold indicator. When the shorter moving average pulls away dramatically from the longer moving average, it is likely the symbol is overextending and will soon return to more realistic levels. And then lastly, divergence. An indication that the end of a current trend may be upon us is when the MACD line diverges from its symbol. So in other words, we see here prices falling in a downtrend, prices making lower lows. Okay. The indicator, the MACD line, is simply making higher lows. It's just moving away in the opposite direction of price. In most cases, you notice it moves with price. When it diverges from price, it's telling us something is wrong with the current trend. Now, divergence is usable in most indicators. You have the same explanation or same interpretation for divergence, whether you're using RSI, stochastics. So basically, we come down to MACD is a histogram, is a derivative of a derivative of a derivative of a derivative. So the MACD histogram is an indicator of an indicator. In fact, the MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from the price of the underlying security. In other words, it's a 4th derivative of price. So again, we start out with the first derivative, is the 12-period EMA and the 26-period EMA, the 2 lines we put on the chart. Then the second derivative is the 12 EMA minus the 26 EMA, which form the MACD line, which was the blue line we put below. The third derivative was the signal line, which was the 9-day EMA of the MACD line. That was the gold line we put below. And the fourth derivative is the MACD histogram, which is the MACD minus its signal line. So the base for the indicator is the securities price. It takes 4 steps to get from the actual price to the MACD histogram. While not necessarily a bad thing, charters should keep in mind when analyzing the MACD histogram, it's an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in the price momentum of the underlying security. So let me share with you a little presentation on how you could adapt MACD to fit your trading.
How fast the indicator is going to react to price change. Most of us will probably be chopped to pieces if we rely on only a short-term trading indicator as the basis for any trading system. The MACD line is faster than the signal line, and it's the result of the difference between the fast and the slow moving average. Many traders will use the line as a proxy for momentum. But to make it simpler, think of it as measuring the rate of change of price. The signal line in the MACD is slower due to its setting, and traders will often use that as a trend determination tool, either using multiple time frames or just one trading chart. And knowing that we measure trend and momentum, you may already see how we can use the MACD to actually trade with when we use both the MACD line and the signal line to alert us to possible changes in the market. The 2-line cross can be a powerful indicator of trading potential in the market. Here we've set up the indicator on our chart, and we're going to use the standard settings as we talked about earlier, and we're going to read the MACD. When we want to determine trend direction via the MACD, we can look at where the MACD line is in relation to the signal line. If the MACD line is below, in between the red lines on the chart, we're looking for a short trade. If we see the MACD line is above the signal line, between the green line, This is going to indicate a market in an uptrend, and you'd be bullish on any trading setup. And as mentioned, we're really looking at the rate of change of price. So even though the lines are crossed, price may be compressing. This is one reason that multiple time frame trading is suitable for this trading indicator. You simply look to short rallies during a MACD downtrend and buy pullbacks during an uptrend. And some traders will use the MACD signal line crossovers to buy or sell the market. You may want to consider other variables such as price structure, multiple time frame considerations, and price action in conjunction with trading a simple cross. Once the MACD line crosses over the signal line to the downside, that would be bearish, and you could use that as a signal. Conversely, if the MACD line crosses to the upside, you'd be bullish, and you can use that as a buy signal. And we talked about the fast line being a proxy for momentum. And there may be times where you'll not want to wait for a complete crossover of the MACD to take a trade. So I want to draw your attention to the black round circle at the top of the chart. Here's a pin bar, and it formed after a run up in price. Also notice the separation in the MACD indicator as price approaches the region, in the same region of previous resistance that's not really seen on this chart. And it shows decent momentum in this market. We see the separation decreasing as price slows down and then explodes to the upside, but closes on its open as seen on the pin bar. This is bearish. Now bring your eyes to the fast line of the MACD, and you can see it hooked to the downside. Given the context of price action and structure, you could gain an early entry into a possible reversal. Depending on the context of the chart, you can use the fast line hook as a buy signal or a sell signal. These can be used to enter the market or as a profit-taking indicator, but doesn't matter. Well, this is a weekly chart, and you would have entered 5 or 6 bars earlier, and you've been up over 120 pips before that breakdown happened. What about divergence? I'm not going to talk about divergence, simply because this also takes into account price action and structure. And I find the normal teachings about divergence has way too many holes, because if you trade just the indicator, you're setting yourself up for a failure. Another way that we can use this indicator is to take advantage of the zero line and the fast line as a means of trade entry. Again, keep in mind the lagging nature of all indicators with this trading method, and highly consider using multiple time frames for your trading. You can see the change in trend when during the moving average crossover, so we know we're looking for a short trade. Once the fast line crosses the zero line, this could be a trade entry. You can see how mechanical this is, but it also gets you in very late in the move. You can see on the inset on this graphic that this is the daily chart, and the red line indicates where, after the weekly trend turns down, you would enter on the daily chart using the zero line cross. That black line is where you'd enter on the weekly chart 2 months later. So in summary, with the MACD, we do have a useful technical analysis tool. It has quite a few uses, and we talked about how to determine the trend using the 2-line cross, how to read momentum using the fast line, trade entry using a fast line hook, trade entry using a zero line cross, the benefits of multiple time frame analysis. And as with all technical indicators, you want to test this as part of an overall trading plan. Also, be aware of the lag time using this indicator, although for some traders, it'll be an advantage as you're not picking tops and the bottoms. You may also want to...
So remember, as I said, MACD doesn't tell us how far an asset's going to move. So one of the most popular ways of using MACD, and we keep saying this over and over, is to generate transaction signals. A lot of people, when you say a buy signal and a sell signal, means they think they should just buy now, sell now. So I try to convince everybody that these are buy alerts. Okay. So it's telling you that a buy or a sell opportunity has presented itself. So when we get the crossover of the MACD line and the signal line, when the MACD line crosses over its signal line rising, it's hitting you on the back of the head and saying, hey, trader, look at me, there could be a buy opportunity here. Quickly do some other studies and make a determination. So the biggest disadvantage of using this indicator to generate transactions is that a trader can get whipsawed in and out of a position several times before being able to capture a strong change in momentum. As you can see in the chart, the lagging aspect of this indicator can generate several transaction signals during a prolonged move. And this may cause a trader to realize some unimpressive gains or even small losses during that rally. So traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets, because relatively small movements can cause the indicator to change direction quickly. The large number of false signals can result in a trader taking many losses. When commissions are factored in the equation, this strategy can become expensive. Now, the MACD indicator is the most popular tool in technical analysis, especially online CFD trading and Forex trading, because it gives traders the ability to quickly and easily identify the short-term and trend direction. The clear transaction signals help minimize the subjectivity involved in trading, and the crosses over the signal line make it easy for traders to ensure that they are trading in the direction of the momentum. Very few indicators in technical analysis have proved to be more reliable than the MACD, and this is a relatively simple indicator, can quickly be incorporated into any short-term trading strategy. So if there was ever a quest in the world of investing on par with the search of the Holy Grail, it would be acquiring ability to spot trend changes. There are many ways investors attempt to do this with varying degrees of success, but the common trend tracking tool is the two-line moving average convergence and divergence. This tool measures an asset's momentum and can aid you in spotting changes in market sentiment. So remember, momentum in charting is similar to momentum in physics. If you throw a ball in the air, it will ascend at a slower and slower pace the higher it projects. After monitoring a change in momentum, a person can determine when the ball will stop climbing and change direction and descend. So just like in physics, momentum changes can occur before the price of an asset changes. And this is what MACD helps us see. So the strength of the current trend can be measured by channeling the MACD. Spot trend reversals by looking for divergence in momentum, and determine buy and sell signals using the MACD crossovers and bounce offs. So remember, like life, trading is rarely black and white. Some rules that traders agree on blindly, such as never adding to a loser, can be successfully broken to achieve extraordinary profits. However, a logical methodological approach for violating these important money management rules needs to be established before attempting to capture gains. In the case of the MACD histogram, trading the indicator instead of the price offers a new way to trade an old idea. Applying this method to the Forex market, which allows effortless scaling up of positions, makes this idea even more intriguing to day traders and position traders alike. So, I've explained all this in great detail in that MACD indicator handout guide. I've given you chart after chart with step-by-step information so that you can follow along and see all of these and follow them while you're actually trying to put them on your own charts. It's also covered in the technical indicators guide from investing.com, and it's detailed out in the introduction to technical analysis. All three that I've given you as handouts tonight. So make sure you download those. And if you have any questions, you can contact UBCFX at www.ubcfx.com or go to their education center. They have a great deal of information on MACD, from an introductory guide to more advanced strategies using MACD. And on that note, we're going to say goodnight. I'm going to wish you a happy holiday weekend, no matter what you celebrate, whether you're celebrating spring or the Jewish holidays or the Christian holidays. It's a holiday weekend, and hopefully everybody will enjoy. So thank you very much for joining us tonight, and we'll talk to you again real soon. Bye now.